The crypto tax loophole that can save you thousands. If you've been in the crypto market for more than 5 minutes, you already know how much of a roller coaster it can be. One week, your portfolio is on a tear, and the next, it feels like everything's crashing. And while those dips can feel painful, there's actually a silver lining. What if I told you those downturns could help you save thousands on your next tax bill? Today, I'm going to explain how crypto tax loss harvesting works, break down the loopholes and risks, and help you figure out how and when to use this strategy to your advantage. Hi, I'm Justin Kuntz, Managing Director of Pacific Wealth Management, helping you make good financial decisions through sound management for a secure future. Let's start with what tax loss harvesting actually is. When you buy a cryptocurrency and the price goes down, that's called an unrealized loss. It's just numbers on a screen until you actually sell. Tax loss harvesting is a strategy that involves selling assets at a loss to offset gains in other investments. Here's a simple example. Let's say you bought $50,000 worth of Ethereum, but now it's only worth $30,000. If you sell, you've locked in a $20,000 loss. Now imagine you also sold some stocks this year for a $15,000 profit. Normally, you'd owe tax on that gain. But by harvesting the Ethereum loss, you've offset those gains, and your tax bill on those trades drops to zero. And since the stock gain only used up about $15,000 of your $20,000 loss, you'd still have $5,000 left over. With that, you can apply up to $3,000 against your ordinary income this year, and the remaining $2,000 can be carried forward into the next year. So, what feels like a setback can actually become a long-term tax advantage. Now, here's where crypto differs from regular securities or stocks. If you traded stocks before, you've probably heard of a wash sale rule. That's with a rule that says you can't sell a stock at a loss and then buy it back within 30 days just to claim the deduction. But crypto is treated differently. Right now, the IRS classifies cryptocurrency as property, not securities. That means that the wash sale rule doesn't apply, at least not for now. So technically, you could sell Bitcoin today at a loss, buy it back immediately, and you'd still be able to offset your gains or ordinary income. It's important to note, however, that lawmakers have already proposed several bills that aim to close this loophole, so it's important to keep an eye out for any changes in the future. If the rules do change in the future, there are still some safe ways you can harvest losses. The first is to wait 30 days before buying back the same asset. While this is the easiest approach, you risk missing out on some gains during that time. The second is to swap it into a correlated asset. For example, let's say you sell Solana at a loss. Instead of sitting on the sidelines for a month, you could buy another coin that tends to move in sync with Solana. That way, you stay invested in the market while harvesting the loss, and after 30 days, you can switch it back if you want to. Now let's talk about who benefits the most from tax loss harvesting. This strategy is especially powerful for high net worth individuals since every dollar of losses you use to offset gains reduces income that would otherwise be taxed at a maximum rate on the federal level of 20% for long-term and 37% for short-term gains. On the other hand, if you're on a lower tax bracket, the impact is going to be a lot less consequential. If you already qualify for a 0% rate on long-term capital gains, tax loss harvesting is only meaningful if you're offsetting short-term gains or ordinary income. Timing is another critical factor. The deadline for tax loss harvesting is December 31st of that tax year, but waiting until the last month or week of the year can be risky. A better approach is to harvest losses throughout the year whenever there's a market downturn. Doing this consistently can give you more opportunities to save, instead of trying to cram everything in at the deadline. Overall, there are a few things you need to remember. 1. Selling crypto at a loss can offset capital gains and reduce your taxable ordinary income by up to $3,000 per year. Unused losses can be carried forward into future years as well. 2. Wash sale rules don't currently apply to crypto, so you can technically sell the asset at a loss and buy it back the same day without being disqualified from tax advantages. 3. Another strategy in case tax laws change is to wait 30 days or buy a correlated asset instead of jumping right back in. 4. When it comes to timing sales, take advantage of market downturns throughout the year. And that's usually the most effective way of doing things rather than waiting until the last minute. Overall, tax loss harvesting is one of the most effective legal strategies to reduce your tax bill. As of now, no legislation has passed to include crypto in the wash sale rule, but that could change in the future. Tax rules are complicated, and crypto regulation is constantly changing, so it's always smart to work with a qualified financial professional before making any big moves. I'm Justin Kuntz, Managing Director of Pacific Wealth Management, and if you're interested in seeing how we help our clients at Pacific Wealth get the most out of life with their money, visit us at www.pacwealth.com. Thanks.